The name meant Holy Spirit. The family had run the bank for 5 generations, 150 years of Portuguese banking tradition. Then in one summer in 2014 it was gone. Nearly €5 billion to rescue it. The patriarch arrested. The savings of ordinary Portuguese people, invested in debt they never knew they were buying. This is Banco Espirito Santo. The name meant Holy Spirit, and the bank had been in the same family for 5 generations, and it was one of the oldest and most prestigious financial institutions in Portugal, and for most of its nearly 150-year history it had been the embodiment of Portuguese banking tradition. Conservative, family-controlled, trusted by generations of depositors. And then in the summer of 2014 it collapsed, and the Portuguese government had to commit nearly €5 billion to rescue it. And the investigation that followed revealed that the bank had been concealing losses and manipulating its accounts for years, hiding the financial problems of the broader Espirito Santo family business empire inside the bank's balance sheet and presenting accounts to investors and regulators that bore increasingly little relationship to the underlying financial reality. And the patriarch of the family, who had served as CEO, Ricardo Salgado, was arrested and charged with money laundering, tax fraud and other offenses. And the story of Banco Espirito Santo is the story of how family honor and institutional pride can become the mechanisms of deception when a dynasty refuses to acknowledge that its empire is collapsing. The Espirito Santo family had been involved in Portuguese banking since 1869, and the bank that bore the family name had become one of Portugal's most important financial institutions, growing through the 20th century to become a major commercial bank serving millions of customers. And by the early 2000s the Espirito Santo Group had evolved into a complex international conglomerate with interests across banking, insurance, real estate, and various other sectors spread across Portugal, Brazil, Angola, and numerous other countries. And the family's control of the group was exercised through a complex web of holding companies that made it difficult for outside investors and regulators to see the full financial picture. The problems that would eventually destroy the bank had their origins in the aggressive expansion of the broader Espirito Santo business empire through the 2000s, and in particular in the financial health of the non-banking parts of the group, the holding companies and the various business interests that the family controlled. And these non-banking entities had accumulated significant debts and financial difficulties that were being hidden from the market through a variety of mechanisms, including the issuance of commercial paper, short-term debt instruments, to the clients of the bank's own branches in Portugal, meaning that ordinary retail customers were unknowingly buying debt issued by financially troubled family holding companies because the bank staff were selling it to them as safe investments. By 2013 and into 2014 it was becoming increasingly clear to those who examined the group's finances carefully that the Espirito Santo empire was in serious financial difficulty, and a series of accounting irregularities were detected in the accounts of Espirito Santo International, one of the family holding companies. And these irregularities triggered a formal investigation by the Portuguese securities regulator, and the disclosure of the investigation caused significant concern in the financial markets about the health of the bank itself. In July 2014 Banco Espirito Santo released financial results showing losses of over €3.5 billion for the first half of 2014, far larger than the market had anticipated. And the disclosure of these losses, combined with the ongoing concerns about the holding company irregularities, effectively ended the bank's ability to raise new capital from the markets. And on August 3, 2014 the Bank of Portugal announced an emergency resolution of Banco Espirito Santo. The bank was split in two, with the good assets and deposits transferred to a new institution called Novo Banco, New Bank, while the bad assets and the shareholder and subordinated bondholder claims remained in the old Banco Espirito Santo, which was wound down. The resolution cost approximately €4.9 billion, which was provided through the Portuguese Bank Resolution Fund supported by government backing, and this represented a significant burden for Portugal, which was itself still recovering from the severe economic crisis and IMF bailout of 2011 and the political controversy surrounding the resolution, particularly the question of why the subordinated bondholders were bailed in while depositors were protected, became one of the most contentious financial policy debates in Portugal in the post-crisis period. Ricardo Salgado, who had served as CEO of the bank and was regarded as the dominant figure in the Espirito Santo empire, was arrested in July 2014 and subsequently charged with money laundering, qualified tax fraud, abuse of trust, and other offenses. And the investigation also extended to other members of the family and to other executives who had been involved in managing the group's affairs, and the legal proceedings were complex and lengthy, reflecting the complexity of the corporate structure that had been used to manage and obscure the group's finances. The Novo Banco that was created from the good assets of the original bank had a complicated subsequent history, It required additional state support in subsequent years as further losses emerged from the original portfolio, and it was eventually sold to the American private equity firm Lone Star Funds in 2017, and the resolution of Banco Espirito Santo and the subsequent management of Novo Banco became one of the most studied examples of the bank resolution framework that European regulators had put in place following the financial crisis. So what is the real lesson of Banco Espirito Santo? And the lesson is about how institutional legitimacy and family tradition can function as a substitute for transparency. The Espirito Santo family had been in Portuguese banking for nearly 150 years, and this history created a presumption of trustworthiness that made it easier for problems to be concealed and harder for regulators and investors to ask the searching questions that the group's complex structure should have prompted. The same heritage that made the bank one of Portugal's most trusted institutions also created the cultural environment in which acknowledging financial difficulty felt like a betrayal of the family legacy. And the result was that problems were hidden rather than addressed until they had grown too large to survive. And the people who paid the price were the retail depositors who had been sold the holding company's commercial paper, who had trusted the family bank with their savings, and who found themselves holding debt issued by a failed conglomerate. That is the capital case. Subscribe to the capital case because the next case is already waiting.